Good morning and welcome to this Wednesday, October 6th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures pointing down again. I'm not shocked. We got an ADP report out this morning, ADP employment report. We'll talk about that in just a minute. But yeah, I mean, market still in this little bit of a funk, downtrend, growth stocks out of favor. There are still areas, though, that are moving higher. I mean, financials are doing really well. Energy's been doing well. Industrials, certain parts of industrials doing well. It's really just been, move again away from the growth area. So this rotation that has been the hallmark of 2021 is striking again right now. And we'll see. I mean, the problem is you move everything into the financials and industrials, you better be prepared to move right back out if the yield starts to turn back down. Now, I believe in the short term, yield's probably going to go a little bit higher. So I would continue to stick in the short term with some of those financial trades, maybe some industrials and so forth. And we know historically that these areas are favored really throughout not just October, but into November as well. But we're going to get into all that in just a minute. First, let me take you over to Earnings Beats for those of you who are new to Earnings Beats. Just want to let you know that if you want to learn more about us, you can go over to earningsbeats.com. Got a lot of great information over here, but the main thing is consider subscribing to our free Earnings Beats Digest. It's a completely free, no credit card required. You can unsubscribe at any time. All it requires is name and email address. Hit that subscribe button. We publish articles 3 times a week, Mondays, Wednesdays, and Fridays. Typically out around 8:30 in the morning, usually try to give you about an hour before the market opens. Take a look. Very easy to digest. It is, normally just a couple paragraphs in a chart. So pretty simple, but it will help explain a little bit about what we do and how we look at the market. A lot of relative strength analysis, a lot of earnings, looking at gaps, candlesticks, that sort of thing. We'd love to have you. So make sure you go over to earningsbeats.com, check that out. Moving on to the action from Tuesday. Well, I mean, we had a bounce back day. That's good news. Unfortunately, we're still in a downtrend. So we didn't get through key moving averages, especially on our 3 major indices. You can see the Dow Jones, even though it's up 312 points, we did finish just shy of the 20-day moving average. Still got another 100 points or so to go, maybe a couple hundred points. S&P 500 finished up 45 points, so more than 1%. Strong day on the S&P, but that 20-day moving average sitting up at 43.97, and we finished at 43.45. So that downtrend, we're still price action still below the 20-day, the 20-day below the 50-day, PPO still pointing lower. That's a very bearish short-term configuration. Long-term, I'm not as concerned, but short-term, yeah, when the market's weak, you got to be careful. NASDAQ up 178 points. So yeah, nice rebound there, 1.25%, but that same configuration in play. And we've lost the August low, trying to hold on. I mean, this 14,200 level from a short-term perspective, I think is pretty important because that was a double top breakout that we saw back in June. And at the time, that ascending triangle pattern measured up to almost 16,000, which we got up to about 15.4. And now we've come back down. I'd really like to hold this 14.2 area in the near term. If we don't, I think it starts to turn more into an intermediate term problem rather than a short term problem. Mid caps did finish up. They were up 5 points. Small caps were up 4 points, but you can see on a percentage basis, much less than the other two. So mid caps, small caps really didn't perform as well. They were doing better on the upside. Their recoveries were stronger. But now as we kind of, we have some of these bounce back days of late, the last couple of days, we haven't seen as much strength out of this group. So I look at the charts and I'm just seeing sideways consolidation out of both of these indices, mid caps and small caps, whereas S&P and NASDAQ in particular were clearly in uptrends, but they've now been, maybe taken down at least temporarily with this ABC, what I think is an ABC correction. Financials up almost 2%. So they led again yesterday. They're on the verge of a breakout. Close above 39 would be bullish on the XLF. Communication services, not so much. I mean, we had a good day yesterday, up 1.5%. but we're in a downtrend, and that configuration very negative, just like I talked about on the S&P and the NASDAQ. Technology, same thing, up 1.4%, but we're in that negative, that more bearish short-term configuration. Industrials, the same. We did finish up 1.12%. We got up, closed at 99.74. The 20-day is 100.33, so we're not far on industrials moving up. But the thing that's kind of interesting to me is financials and industrials both tend to do well when yields are rising. Yet you can see there's been a pretty big disparity in their performance over the last month. Industrial still in a downtrend, whereas, as I mentioned, financials trying to make a breakout. So hasn't been the same type of reaction in the industrials as it has in financials. And until we get the transports going and they continue to trend lower, they're giving signs of maybe turning it around. But until transports turn it around, it's going to be really hard for industrials to do a whole lot. Real estate, in the meantime, was the big loser on Tuesday, falling about 0.75%. Continuing their slide from their early September high. All right, 10-year Treasury yield. So this morning we get the ADP employment report for September. Expectation was 428,000 jobs. We got 568,000. So better than expected. So you would think, okay, that means folks are going to want to sell bonds. Yields will be up. Well, of course not, because that's what you would expect. So the yields are actually down about a basis point. But I think the fact that we're moving up prices in, the fact the yields have been moving up, prices in the better than expected economic news. I think that's why we've been seeing selling of bonds. And that's why I think we're probably going to continue to see it. I don't think it's going to be a mass sell-off. I don't see the 10-year Treasury yield shooting higher. If it does, if it breaks out above 175 and really takes off, then yeah, the growth stocks are going to continue to get hit, especially on a relative basis. I see the market going higher. And I think we just kind of have to keep playing it by ear as we go along as to which area of the market, whether it's growth or whether it's value, which area leads, because that's been the more difficult part of the stock market in 2021. And this is something I talked about literally almost a year ago. I talked about how bullish I was, but the more difficult part was going to be the rotation. Where do you want to put your money in the market to try to outperform the S&P 500? And it seems like, it's that old magician's trick, where you've got all the dishes on the table and they pull the tablecloth out. I mean, I don't know don't try this at home, but if you did try it, I'm sure you're going to have a mess with dishes everywhere. Well, market makers are magicians, so they can do it. They pull that stuff right out from under us. And it makes it really hard because we go from certain areas of the market leading to all of a sudden they can't catch a bid. As I showed you just a moment ago, real estate, beginning of September, real estate, there wasn't a better sector. Now, after 5 weeks of continued pounding to the downside, there's not really a weaker area. This all took place in a month. What happened? Well, welcome to the 2021 stock market, because that's what we've been dealing with all year. Some of it makes sense, some of it doesn't. When the yields are rising, financials outperform. That's pretty much been the case. You can see that here on this chart. As the yields have been moving back up, look at financials on a relative basis. This is a relative chart here of the XLF versus the S&P 500. That is a relationship, an intermarket relationship that has withstood the test of time. When rates are going up, typically your financials are going to outperform. So as long as you look at the 10-year Treasury yield, as long as we keep trending up above the 20-day, financials isn't a bad place to be trading. That's the area that seems to be getting the most love right now, along with energy, of course. And crude oil prices have been moving up pretty significantly. And that's certainly one of the things driving that area. I will say, though, crude oil down 1.25% this morning. So energy probably going to give back some of its recent gains. And energy has been moving up, but threatening and testing a long-term area of resistance on the XLE. In fact, I'll go ahead and before I go into the talking technically, I'll just pull that up for you and show you. So if we look at the XLE, you can see the strength, but you can also see the recent top there. That's not just a recent top. If we go back the last 4 years on this daily chart, you can see the top there. But look at where we topped in the beginning of 2020, right before the pandemic. Look at where we topped in September, just prior. I mean, all of these are coming in right at that 55, 56 level. Yesterday's high was 56.05. So this is an area that's going to be somewhat difficult to negotiate. And as easy as it was maybe to get back some of these gains off of the pandemic low, especially, but even back since the positive vaccine news came out in November, this move back to the upside was just getting back this free fall. Now that we're up to 56, I think energy is going to have to earn what it's going to get going forward. And it's going to come down to two things. Does crude oil keep moving higher? Well, it's not this morning. And then the other thing is the dollar. If the dollar continues in an uptrend, and I'll just pull up the UUP so you can see what's been going on here the last few months. I mean, we just moved to about an 11-month high on the dollar just last week. So if that continues, if we continue to see the dollar trending higher and the XLE is up against key resistance, I think that's going to make it very, very difficult for energy. All right, moving on, let's talk technically here. Looking at the S&P 500, in the daily market report yesterday I sent out to members, I said I wouldn't be surprised if all of a sudden, we're back down this morning. And the reason I said that is that the reasons that folks have been selling have been the higher yields. And the yield's still in an uptrend. The yield actually went up yesterday. I mean, if we pull up the 10-year Treasury yield, even though growth stocks came back somewhat, look at the Treasury yield moving higher. Now today, the Treasury yield's moved up at the open, pulled back a little bit since. But now today, we're seeing the NASDAQ on a relative basis. Let me just make sure that's still the case. Relative basis, NASDAQ was the worst performer. Yeah, right now we've got NAS futures down about 1%, by the way. S&P futures down just a little less than that. Dow futures down about 0.8%. So it looks like we're going to get off to a rough start. But getting back to that S&P 500, you can see each of these reaction highs, there we had a double top at about 43.85. Then when we got the buying back on Friday of last week, we got up to about 43.75. And then when we got to the highs yesterday, we got to a high of about almost 43.70. So these highs are just lower and lower. We haven't changed this pattern yet on the S&P 500. And this is part of what's bothering me. And then you look at the NASDAQ and you see the same thing, maybe even more so in terms of the steepness of the move to the downside. And if you want to take a look at how the S&P versus the the NASDAQ 100, that's SPDR, QQQ, SPY, QQQ, that'll give you the 15-minute relative strength, which the SPDR has been outperforming the Qs. And when I do these charts, I usually like to get it off of the candlestick. Go to the line chart. But you can see that the trend here has been higher. So yesterday, yeah, we got a little bit of a reprieve, but we got the same reprieve back on Thursday of last week when the SPDR went down relative to the NASDAQ and then right back up again. So yeah, we pulled back, but does that mean it's over? I think it's too early to say that. We need to see this ratio start to roll back over the other way. We need to see the QQQ leading for more than just one day. That would be step number one. Step number two, we need to get the market back up above the 20-day EMA. Until we can get things moving in that direction, back to the upside, and until we start to clear some key technical hurdles, I think you just have to be careful in the near term. And, I get asked a lot, what does careful mean? Well, it means different things to different people. I would say if you're somebody that is constantly using margin, so you're borrowing to invest in the market, I wouldn't be doing that in this kind of market. That to me is incredibly risky in a downtrending market. If you're somebody who normally takes big positions in fewer stocks, I would think about taking much smaller positions in those stocks and maybe leaving some cash. If you're somebody who maybe, does individual stocks, but you want to lessen your exposure, maybe go to ETFs. Those are the types of things that I would suggest. But obviously the number one thing is just simply being in cash. Now, if you're really aggressive, you can short the market. I'm not interested in shorting. I believe we're in a secular bull market. And if you look at the charts, if we pull up an S&P 500 chart, just the SPX, and we go back let's go back the last 8 years. Look at this chart. Would you rather be on the long side or would you rather be on the short side? I think this chart kind of speaks for itself. Now, do we have periods of weakness? Sure. But if you're constantly betting against this market, I don't know how you're doing better than somebody who's constantly betting on it, or going with it. I think it's pretty clear that we're going up a lot more than we're going down. But when we start to go down, the VIX is on the rise. You do have to take some extra precautions as a trader. Long-term buy and hold is a completely different animal. And I get questions, I think, because people get confused when I start talking about, well, maybe raise some cash. If we're talking about somebody who's buy and hold, I think we're in a secular bull market. You literally buy and hold through it. You don't worry about the short-term weakness. You don't try to time the market. If you're a trader, you do try to time the market. You do try to, put more in the market when it's doing well and less in the market when it's going down. So those are just some key points that I wanted to make. All right. One other chart here on the S&P 500. Now I want you to look at this, and I know a lot of folks think I'm just a perma bull, and that's partially true, I guess. I mean, I'm not a perma bull, but I'm definitely bullish more than I'm bearish. I tend to be very optimistic about the economy and about the growth and growth of profits and so forth. And I think equity prices over time go a lot higher. And if you're constantly bearish and if you're constantly a non-believer in the stock market, I think that can hold you back a lot. So yeah, I'm definitely more bullish than I am bearish. There's no doubt about it. But it's not like I don't try to back it up with what I'm seeing on the charts and the intermarket relationships and so forth. Over the last month, this is a chart of the S&P 500. It's been going down for the last month. Now, normally what happens when the market goes down, normal market behavior, whenever we get into a downtrend, is money flows into defensive areas on a relative basis. Now, I want you to look at where we stand. I mean, we're down close to the lows over the last month, and look at where we stand on the defensive groups relative to the S&P 500. So this is healthcare versus the S&P 500. Right now, we're at a 1 month relative low. Here's consumer staples. Well, we're not at a 1 month relative low, but we're much closer to the low than we are to the high. So it's not like money is pouring into consumer staple stocks. How about real estate? Remember, real estate was doing really well a month ago, way up here. Well, now on a relative basis, it's been downtrending. And then you got utilities, which over the last week or so has started to bounce back a little bit. But for the most part, it's been downtrending, and it's still closer to its 50 or 1 month relative low. So when I look at this, I just try to think from a common sense perspective. The stock market, if we're going to go lower, if the stock market is imminently heading lower, we should see money. Wall Street should be pouring money into defensive areas relative to aggressive areas. I'm not talking about how much money goes in stocks versus how much money goes into bonds. I'm saying what goes into stocks. Where is it going? What does the rotation look like? Why on earth would anybody that believes the stock market's going down underweight defensive areas like they've been doing over the last month? Makes no sense to me. So, partly, and I see financials, trying to break out. Are financials going to break out in the midst of or right before a big downturn in the economy and in the stock market? I don't think so. Are yields going to rise just before a big downturn in the economy? I don't think so. I don't think you'd be selling bonds. You'd be buying bonds if you thought that the economy was going to be in a downturn. So the intermarket is what's driving me. It's not Tom's a perma bull. It's Tom's looking at the charts, and the charts tell him to be bullish. Now, can I tell you exactly when this weakness ends? I wish I could. I can't. I wish I could tell myself. I could do a lot better in this market myself if I knew exactly. I just know that the market's going down. I know growth stocks right now are being hit. And if you haven't seen that, I mean, we could pull up, let's pull up the DJUSGS versus the DJUSVS. It's a good relationship. I used to do the IWF, IWD. I think this is a better gauge, only because the IWF is made up of, I forget the percentage, but it's a very high percentage of like the top 10 growth stocks, the real large mega cap stocks like the Apples and so forth. So I just find this maybe to be more representative of a bigger picture of what's going on in the market. So I've been using the DJUS GS, which is small cap growth index versus small cap value index. But I mean, look at what's going on here. I mean, we're continuing to move lower. Do I expect it? Do I think that this is the right thing? No. I believe eventually growth stocks are going to outperform. I think they're going to continue to outperform in a secular bull market. But I think a lot of the selling and a lot of the weakness that we see triggers more selling for market makers and portfolio managers, hedge funds to build positions. So I want to continue to look for the leadership in the growth areas because I believe those that are leading in a down market are likely to perform very well in a move back to the upside. But anyway, this is that chart right here I just wanted to point out. So we're downtrending right now. Growth versus value is downtrending. And it makes some sense when the yields are rising. But I think in the end, we'll see that the growth stocks actually turn out to be quite a value deal when you think about it. Based on what I think growth is going to do and the fact that we're still in a historically low interest rate environment. Okay, last thing, a couple of things I still want to do, but one thing I want to do is to break down the specialty retail group. And actually, I'll go back over here for a second. So if I pull up the Dow Jones US specialty retailers and compare it to the S&P 500, and let's go with that line chart. I think you can probably see that some strength is taking place. A lot of money now rotating towards specialty retailers. We bottomed in June. We set a high. We pulled back, put in a higher low, and then we broke out and we're trending higher. PPO looks good. I think on a relative basis, this is a really strong area within consumer discretionary. And I still am a fan of consumer discretionary. I feel like I've been singing that tune for a long time and I haven't really been right a whole lot. Maybe, it seems like it goes up like everything else. Rotation sends it, flying to the upside. And then all of a sudden the carpet's, taken out from under us. But I believe we're going to see strength in consumer discretionary as we head toward the end of the year. And so I'm looking for pockets, areas within the group that are showing strength. And this is one of those. So when I see strength, and we have an industry group relative strength chart list that we provide to our annual members at Earnings Beats. And so you can be looking at this at any time. It's a 3-year weekly chart, but you can kind of start to gauge some of the strength. And the way I would use this, if I'm looking and I like specialty retailers, what I would do, and we're getting ready to head into earnings season, we have a raised guidance chart list that we keep track of at Earnings Beats. We watch companies that are raising guidance, whether it's revenues, whether it's earnings, whether it's both. I don't care. If they're coming out and they're raising guidance, then we try to keep track of it in a chart list so we know which companies have been raising guidance as we head toward earnings season. One way to take advantage of looking at the relative strength in the industry groups and then also knowing the fundamental data, which companies have been raising guidance, we can run a scan. So I'm going to show you what I would do. I would just run a new scan. Raised guidance already has, obviously it's going to have all stocks in it, and it's already got volume. I mean, we've already looked at volume before we included it in the raised guidance chart list. So I don't need any of that. All I need is 2 things to run this scan. Number one, I want to go into the cyclical area and grab the specialty retail group. So now it's going to look in this scan. It's going to go into the scan engine. It's going to find all the stocks that are listed as specialty retailers. The only other thing I'm going to do is I'm going to pull up my raised guidance chart list. So that quickly, once I see specialty retails doing well, I can go find companies that have raised guidance that are in the specialty retail group. All right. And it doesn't mean that all these stocks are going to be great stocks, but it's going to be at least a good starting point to try to find companies, leading companies within a leading industry group. All right. So I'm just going to run the scan and just see what comes up. 14 of them. Now I can then sort this by Scooter to find the best ones. Scooter's stock charts technical rank, which is, it's a relative strength indicator. I'll just point out the one weakness in the scooter, as I see it, is that if you look at the formula, it only goes back about the last 5 months. So if you're looking at big picture over the last year or 2 years, Scooter's not helping you with that. Scooter's going to look at how various asset classes, stocks within asset classes are ranked based on certain performance metrics over the last 5 months or so. Anyway, Build-A-Bear Workshop 97. Then you got Big Five Sporting Goods, Academy Sports, or O'Reilly, right down the list. And so you can kind of get a feel for which of the stocks that are in our raised guidance. Now, it doesn't mean there aren't other companies in specialty retail that are really strong. These are just ones that we know have raised guidance in the last 3 months. So I'm going to pull up Build-A-Bear and just look at the chart and just see, well, I mean, we had this huge move. I think this is a very constructive sideways consolidation. After gapping up in August, there's your gap support, which seems to be holding, and we're right about on it. So I think Build-A-Bear is not a bad trade. Short term, if it breaks below the 50-day, it's also giving up gap support. So maybe you unload it. But for somebody looking for a specific trade in this area, I think Build-A-Bear is a pretty good one. So again, just wanted to point out how you can use our relative strength charts to identify areas where we see momentum, strong momentum moving higher, and then how you can scan against our research that we do to come up with companies that are in great groups, are also, in this case, raising guidance. And then we can look at the charts technically to see if there's, possible entry point. All right. Another thing I wanted to do is just kind of quickly go over the Dow Jones Components. And I'm looking at these on a 1 month basis, period of 1 month. So you can see what's been leading and what hasn't on the Dow Jones. You got consumer finance, American Express, Chevron, energy, that kind of makes sense. Healthcare, I was surprised to see a healthcare up here. We haven't, healthcare hasn't been very strong, but Merck has kind of bucked that trend of healthcare moving lower. JP Morgan, a bank, I would expect that one. Boeing, I was kind of surprised to see Boeing up here, but it is an industrial, and we're starting to see a little bit more love in the industrial area. And if you flip this, you can see what's not been working. So Johnson & Johnson, Apple, Caterpillar, 3M, 2 industrials. So they're going against the grain because we have seen industrials begin to strengthen a little bit, but these two have not. Nike, it's in that discretionary area. Nike has struggled. They reported earnings not that long ago. But again, just another way to use the chart list to look at different time frames. We could do 1 week, 1 month, 3 months, year to date, whatever it is you want to look at. But this is 1 week, and you can see what's been weak and what's been strong. Merck obviously been very strong over the last week. Anyhow, just wanted to point that out. Earnings, I'm going to pull up Constellation Brands. They reported this morning. They missed. I think I talked about this one earlier in the week. I didn't like this move to the downside. Their relative chart was not looking good. I mean, here's their absolute chart. And I mean, versus their group, they're not doing bad, but look versus the S&P. I mean, the whole group's been horrible. So yeah, they've heard that old saying, what is it? Putting pink lipstick on a pig or something. That's kind of what STZ looks like to me. It's in a bad group, but it's been one of the better stocks within the group. But for whatever reason, the market doesn't like the group. And we found out today why. Constellation Brands came up short on their earnings, 238 versus 278, stocks down 1% pre-market. AYI, Acuity Brands, getting a little bit of a bump, up 2%. After reporting better than expected, bottom line 327 versus 289. And then the 3 you must see. Let's wrap this up. And I'm going to give you a couple of stocks here that are going through what I think are character changes. IBKR, been downtrending for a while. It looks to me like we're now starting an uptrend. Here we went up, set a little bit higher high, bounced off our moving averages and just broke out again. Looks like it's trending back to the upside. I like that. National Oil Well, NOV, same kind of a deal, trending down, sideways consolidating, broke out to a new high close over the last two and a half months. So that one looks pretty good. And then we talked about specialty retailers. AN AutoNation, been coming down the last few days. I've been watching it. The volume was much stronger on the way up than it's been on the way down. It did just recently break out. I think maybe this anti-growth sentiment is having a little bit of a negative impact on the stock that's been a pretty good performer. So I just wanted to point that out. All right, that's it for me. The market's about to open and we are done. I want to wish everybody a great day. Let's watch this market, see what happens today, see if we can start an uptrend or whether that downtrend continues. I'll be back tomorrow over at Stock Charts TV. So you can get that right here, Stock Charts TV. I'll be there at 9 a.m. tomorrow morning for your next Trading Places Live. It'll be the recorded version, but I hope you can join me. Everybody have a great day. Happy trading.